Hello and welcome to our fifth financial history webinar. Today we have the pleasure of welcoming Devin Kennedy, who is an assistant professor of history at the University of Wisconsin-Madison. Professor Kennedy holds a PhD in the history of science from Harvard and is writing a book on the role of the manufacturing and financial industries in computer science. Professor Kennedy will be presenting today on his pre-circulated paper, Silent Partners, the Institutionalization of Markets in the Making of Financialization, 1950 to 1970. So the way that we have been organizing the sessions is that we have been dividing it into two parts. For the first 30 minutes, Professor Kennedy will be presenting on his paper, and he will be accepting questions during the second half of the session. We'll be accepting questions on chat, or you can use the raise your hands option. I will help moderate the session. Thank you all for coming. Professor Kennedy, you have the floor. Thank you so much.
Thank you so much. And let me begin by thanking Paula and Sergio for convening this session. I also want to thank Bernardo and Manuel for their work in coordinating this whole series through the fall. It's been a pleasure to see some of the talks, and I'm appreciative of the chance to introduce myself and my work to this community. So my name is Devin Kennedy. I'm an assistant professor in the Department of History at the University of Wisconsin-Madison, where I also teach in the program in the history of science, technology, and medicine. I'm also a fellow in the Holt Center for Science, Technology, and Society at UW-Madison. My main field is the history of technology, and my training is as a historian of science and technology, focusing primarily on the United States in the 20th century. As Paula generously mentioned, my ongoing book project under contract with Columbia University Press is a history of capitalism in the United States after World War II, told through a history of computing into industries, the manufacturing and financial industries. And my aim in that project is to understand the ways in which two industries molded the research priorities of computer science, and reciprocally, how economic, political, and social visions of computing were in turn influential for shaping the course of financialization in particular in the United States. The paper which I've presented for discussion emerged out of research in my doctoral dissertation and then was opened up during the last 18 months, during a part of which I was a postdoctoral fellow at the New York Historical Society, where among other things I had access to a really wonderful collection of oral histories of modern Wall Street that I would recommend to this group. They also have a really great and robust postdoctoral fellowship program, and I know that they are looking for folks who are interested in financial history. So I'd like to begin with an anecdote, the anecdote with which I begin the paper. In 1959, the Wall Street Journal conducted a series of profiles for a series in the paper called In the Market. The aim of the series was to show how the booming stock market of the 1950s was playing a role in the lives of diverse Americans. The profiles fit neatly into a series of somewhat stereotypical figures. Profiles in the series featured wealthy individuals, risk-taking young traders. There was, for instance, the well-heeled doctor betting and losing big on oil and mining stocks, a restaurateur turned day trader trying to live off his stock earnings, a housewife who day traded in their spare time, and a pair of brothers who found themselves, as they described it, on the sucker list. One of the profiles in this series caught my eye and was sort of the beginning of this project. David D., who was profiled by Jack Hinkey for the Wall Street Journal, was an engineer at Texas Instruments. This was a pseudonym he provided. And in his profile, he proudly exclaimed that he was not, in fact, in the stock market. He, quote, didn't pick stocks for the same reason he didn't play golf, because he couldn't spare the time to be good enough and he couldn't stand to lose. So why was this engineer featured in the series? As the journalist writing the article explained, David was in fact in the market, despite his suggestion to the contrary. As an engineer for a successful engineering firm, David's retirement plan was through his company's pension. And that pension, in turn, was heavily invested in a diverse pool of stocks. Therefore, the stock market, the Wall Street Journal explained, had a strong influence on the way David lived his life, the way he spent, and how much money he would have when he retired. David's story is representative of a historic shift on Wall Street and in American capitalism more broadly that took place in the decades following World War II. A shift under which more and more Americans became invested in stock markets indirectly and often without even knowing it. This shift came to be called in the 1960s the institutionalization of stock markets, or as it was often called in the 1960s as well, the institutionalization of wealth. In the 1940s and 1950s, a range of fiduciary institutions began to invest in stocks. These institutions included things like bank trusts, private and public pension funds, insurance companies investing their reserves, as well as nonprofits like universities and endowments. And this accompanied the rise in open-ended investment companies called mutual funds. In my article, I examined the social, legal, and economic conditions for and consequences of this development, including the emergence of a literature highly critical of this development in the late 50s and 1960s, a literature from liberal lawyers who foresaw some of the aspects of what we would later recognize as financialization, the remaking of the business enterprise around a portfolio conception of the firm, short-termism in publicly traded companies, agency problems between firms and owners, and what one author described as the fission of property ownership itself, as the right to revenue from a corporate issue bared an increasingly attenuated relationship with control of the corporation that stock notionally represented. In the late 1940s, pension funds were not invested in a diverse portfolio of stocks. Insurance companies were all but barred from investing in stocks, and university endowments wouldn't think of investing in the stock market. But in the span of just 5 years, however, these groups had entered the market. Throughout the 1950s and 1960s, these trends increased to the extent that by 1965, while only 10% of Americans owned stock directly, 60% had stake in stock through a pension, mutual fund, or through an insurance company. A decade later, more than half of the stock listed at the New York Stock Exchange was owned by these so-called institutions or institutional investors. And these institutions traded in ways that altered the dynamics and mechanisms of stock marketing in America. They were more active, and they forced a reorganization of the business of stock trading, culminating in the development of things including electronic trading platforms, specialized and highly quantitative investment analysis and firms that provided it. And the most well-known effect of the rise of institutions in stock markets was the ending of the fixed commission structure at the New York Stock Exchange, an event that heralded the closure of a chapter in the New York Stock Exchange's dominance in American finance. The ending of fixed commission brokerage led, among other things, to consolidation and a transformation in the brokerage industry. From a broader social and political historical vantage, the shift in this period represented a transition in stock markets as an institution in the United States. From a market marketed and politically associated with small-scale individual and family ownership, as for instance has been described in the work of Julia Ott and Janice Treflet, the stock market became a field dominated by large fiduciary institutions and financial firms that direct capital on behalf of millions of individuals. I suggest in my work that the fragile political ideology of Wall Street, which Julia Ott has described as the shareholders' democracy, began to fragment towards a highly intermediated economic constitution in what I term a republic of proxies, in which financial participation is highly mediated by layers of intermediaries whose responsibility to a client in the market is at best attenuated and in reality basically notional. By 1959, there was growing concern about this development, as it promised to its advocates to both spread the wealth of the post-war boom years, but also to fracture the relationship between capital ownership and economic power that had long been assumed in American capitalism. One way to think of it is the following. The capital I own through my meager 401k bear no resemblance to any meaningful economic power. I have no power to direct firms, nor to work with other shareholders to do so. As one of the critics of institutionalization would describe it in 1959, if the effect of these developments was to make the employee a capitalist, they have only one of the prerogatives that make it desirable to be a capitalist: security. He gains little in the way of economic power or freedom that economic power carries with it. Capitalist, the pensioner may be, but certainly not in the sense that Marx and Adam Smith used the term. I came to this project through my broader research into the history of computing in American capitalism and especially in the American financial markets. A publication of mine from 2017 described the institutional contests, a different sort of institutional contest, at the heart of the introduction of computer systems for managing information flows within the New York Stock Exchange in the 1960s and early 1970s. I described, among other things, the first computer system at the New York Stock Exchange to manage the real-time flow of quotation data from trade reporters out onto the traditional media of financial information, the ticker tape. Conflicts over the development of that system, called the market data system, and the one that followed it, revealed, as I argued in my article, the new social role of financial markets in the United States. Computer technology was so important in the stock market, not because financiers wanted more fast access to information on which to make profit, but instead because regulators and exchange operators saw financial markets as playing an increasingly public role, and a role that that could be reformed through the introduction of computer technology. As more and more Americans became invested in stock exchanges through these indirect means, their status as public institutions was concretized, and institutions contested over technical problems, ones that, among others, Juan Pablo Pardaguera has documented extensively in his recent book on automation and financial markets. Sociologists of financial markets, including Karen Norcetina, Alex Preda, Donald McKenzie, and Juan Pablo, have engaged the role of technology in mediating social and economic conditions within financial markets. My work draws on these perspectives, but tries to connect them with a critical political, economic, and historical framework, especially from perspectives in the history of capitalism and law and political economy. My analysis of the financial market and debates about it and its human and digital infrastructures uses the market as a site to engage a broader history of capitalist development in the United States, as inflected by institutions, technological systems, as well as socio-technical visions. In my archival research on computerization at the New York Stock Exchange and in the emerging national infrastructure for national stock markets in the 1970s, I kept bumping into the story of the institutional investors. I, like maybe many of us, just simply assumed that institutional investing had always existed and not instead, as I came to learn, had been subject to a contested and slowly evolving development, one that coincided almost to the date with the history of computerization in American finance. The computerization of stock markets, therefore, was one aspect of a broader process that I'm exploring in what I present today. A broader process in which capital came to be intermediated through a range of quantitative practices from financial economics that regiment human decision-making about investment, as well as through the new habitus of professional intermediaries, the new bureaucratic institutions, as well as computational and communication technologies themselves. Intermediation was a condition of financialization in this period. Let me describe in depth some of the aspects of my argument, and then I'll describe a bit of the historical material that I present. As I mentioned briefly, by 1966, the growing influence of institutional investors in stock markets was being referred to as the institutionalization of securities markets. Economists and legal scholars gathering at the Wharton School of Commerce and Finance at the University of Pennsylvania used these phrases interchangeably, that is the institutionalization of wealth and the institutionalization of markets. And for the most part, they used these phrases to describe a process whereby a growing share of wealth was controlled and coordinated by institutions. Controlled or directed was another word that was often used. And I'll note that it's important, and I haven't done enough work to quite draw this out enough in the article yet, but to emphasize that the institution and the institutional investor was a constructed category, and it was an odd grouping of institutions for that matter. It included both investment companies as well as fiduciary organizations. What unified these was very little except for the fact that they were intermediating bodies on behalf of pooled groups of investors. I use the phrase the institutionalization of markets as I take it on as an analyst's category, and I do so to expand upon it in order to capture three broad transitions in equity markets and American capitalism between 1950 and 1975. I use it to describe a process whereby specific types of intermediating institutions came to gain influence in the activities of stock markets, both on an organizational level, but also in the ownership of stock itself. Second, I use the phrase to describe a process in which financial markets solidified their status as institutions central to the functioning of the US economy, as venues for capital accumulation, for a productive enterprise, for consumer savings, as well as for welfare allocation through pension and insurance company investing. And third, finally, I use this phrase to describe the way in which professions and a kind of bureaucratic forms of decision-making came to be associated with Wall Street as new quantitative and procedurally rational forms of institutional judgment became the dominant mode of investment behavior. Within financial markets, institutions reordered the way that stock markets operated. As I mentioned, their most famous consequence was their pressure on exchanges that led to the end of the fixed brokerage structure at the New York Stock Exchange. This is often referred to as the deregulation of brokerage rates, but it was really state power forcing the end of price fixing that had been facilitated by the stock exchange. After May Day, May 1st, 1975, brokers could compete for commissions. This was a major concession to the institutions who tended to trade more and more often than direct investors. Institutions tried to buy seats on the exchanges. They became clients to new, more sophisticated analysis companies that were often started by folks with PhDs. And these institutions also inspired the key intellectual problems that would produce financial economic thought in the way we've come to understand it evolving in the 1950s and 60s. Institutions were bureaucracies with bureaucratic forms of decision-making that demanded new ways of trading, knowing, and interacting. And the computerization of trade data and early electronic markets, including block trading systems called AUTEX, as well as the NASDAQ, were really responding to the needs of institutions, not small scale or the notional shareholder democracy of individual investors. The stakes of this process of this process were deeply consequential. For some, like the business writer and consultant Peter Drucker, institutionalization confirmed the vibrancy of American capitalism, which had, it seemed, innovated from whole cloth a form of profit collectivization akin to socialism without a revolution or even the state's intervention. Labor, through pension funds, he argued, had gained access to corporate profits and a promise, though seldom actualized, of engagement in corporate governance. Meanwhile, the middle class, through mutual funds, had new access to markets and money management techniques that had once been the domain of only the very richest. Meanwhile, nonprofits and universities were able to gain a share in the post-war boom years by betting on blue chip stocks that could not, it seemed, help but increase in value. Others, meanwhile, viewed the development more soberly. A group of liberal lawyers and economists associated with the former FDR Brain Trust member Adolph Burl Jr. viewed the scale of capital controlled by institutions as a threat to the tenuous democratic capitalism of the New Deal. the rise of institutional control of corporations threatened to rekindle the, quote, money power of the Gilded Age, and perhaps even at a greater scale. As institutionalization necessarily meant intermediation, it attenuated the ability of shareholding owners to surveil and control firms, leading either to a broad condition of passivity among owners, what Mark Rowe has called the condition of strong managers and weak owners, or in its most radical form, it could lead to consolidation of power within financial institutions. In notes philosophical about what this development meant, Burrell and his associates suggested that this intermediation of capital threatened to fully sever the link between property ownership and economic power, a development often called the fission of property in the 1960s. My article describes these developments in 4 parts. First, I ask, where did institutional capital come from and how did it come to start investing in stock markets? Second, I focus, and relatedly, how did exchanges position themselves as investors for the American industrial economy during the Cold War? So I emphasize a sort of push-pull, that there was both new capital, but also an effort by the exchanges to recruit this capital into stock markets rather than other kinds of investments. And I focus in particular in the second part of my article on a particular process whereby the introduction of institutional investors supported certain claims that the stock market was stable in both technical terms, that is, that stock prices were less volatile when institutional investors were involved, but also that the stock market was now more stable from a professional and organizational perspective, that from the vantage of the market of the 1920s, which a memory that was still very salient during the 1950s, that the presence of these kind of bureaucratic decision makers legitimized the stock market as a safe place to invest institutional capital. Reciprocally, the presence of these institutional investors were used by, among others, the New York Stock Exchange to try and recruit small individual investors on the basis that now the market was a safe place to invest. So there was this circular development that I'll describe in a little bit of detail later on. In the third part of my article, I dive into the social debates around institutionalization in the late 50s and 60s, focusing on the reaction of legal scholars and federal regulators. And in the final part of my article, I describe how beginning in the mid-1960s and culminating in 1975, institutions became dominant in stock exchanges, producing consternation within the financial industry and producing new conflicts about the character of finance under conditions of intermediation, in which, for instance, it became legitimate to argue that fiduciary interest on behalf of third parties made morally dubious actions economically defensible. So, for instance, Henry Mann argued in the 1960s that insider trading should be done by, mutual funds should use insider information to benefit their clients. Just to give a bit of a greater detail into the story that I tell then, I'll just proceed quickly through some of the main arguments I make throughout the paper. I begin by asking, where is this capital coming from? And well, as Michael McCarthy has just described in his history of labor, labor pensions, labor movements in the United States had achieved historic gains in the 1940s, including in the development known as the Treaty of Detroit, as well as in the National Labor Review Board versus Inland Steel, a federal court case which affirmed the rights of unions to negotiate retirement benefits in contract disputes. Another source of capital of institutional capital was insurance companies. As Mark Rowe has described, there was a basically 3-decade-long ban on insurance companies investing in their capital reserves in stocks, but beginning in the 1940s and culminating with an SEC judgment as well as changes in New York state law in 1951, insurance companies began to invest in stock markets. But a key question is, why was this capital invested in stock? Why did pension funds, bank trusts, and insurance companies see stock market investing as a good idea? I make a few arguments in my article about this, but my main argument is that fiduciary rules are performative. That is, what counts as a good investment is codified in common law interpretations of prudency as essentially what others in the industry are doing. So once some firms like Sears and Roebuck started to diversify their portfolio of stocks from just their own company into other firms, or as the Federal Reserve's own retirement plan began to invest in stocks, or as Carnegie Steel did, others within the industry could make legitimate claims that it was a prudent kind of investment. But I also want to note that we shouldn't overemphasize the demand side of this equation. Stock markets, as Janet Scheffler and Julia Ott have described, were actively campaigning for their role in America's industrial economy during this period. And in the 1950s, they courted institutional investors, including by advocating for the role of exchanges as coordinators of capital. And in a moment I describe as the Sputnik moment for American capital markets, in the wake of the Sputnik launch, the New York Stock Exchange began to argue that stock exchanges could play a role in coordinating the shift of capital towards high-tech fields needed for the Cold War. The biggest effort that exchanges made was, in order to court institutional capital, was to advocate for themselves or to reposition themselves as stable economic institutions. As I mentioned, the memory of the 1920s market was still alive and well, and the New York Stock Exchange made a major effort to present stock investment as a stable and sane thing to do. They did this through statistical analysis of volatility in certain blue chip stocks that were of great interest to institutional investors. And institutions and exchanges were locked in a kind of mutually supporting process in this period. Exchanges promoted stability in price as a way to court institutions, while they used the institutions, the way that they traded, their professionalism as a way to market stock exchanges as different from the 1920s. One thing I'll note just parenthetically is that these institutions tended to flock in to a very small number of stocks, blue chip, or what were often called Nifty 50 or favorite 50 stocks. And this led from a kind of broader, this led to kind of shift of worker capital towards America's already largest industrial firms. As the New York Stock Exchange president Keith Funston noted in 1954, institutions are, in short, professionals by their knowledge, skill, and research they have added to the market stature. Stability embodied a range of features in the 50s. It included both a technical measure of stability, meaning the opposite of volatility, but also claims about the technocratic, professional character of the financial industry as it was strengthened by these new parties. Throughout the 50s and 60s, the stock exchange as well as the investment industry had presented the widespread indirect ownership of stocks as a new stage of capitalism itself. Passive investing, like index fund investing, would in many ways embody the virtues of this new capitalism later on. A stake in corporate profits owned through an investment vehicle engineered to have less risk and to be cheaper than direct investment. And yet, at the same time, these dynamics led to new concerns about power, economic power, and the new sites of power that the financial industry was developing around this new coordinating role. So I described some of the critiques of this development, including, that were really centered at the Century Fund, a kind of liberal think tank in New York, as well as the work of the Jesuit legal scholar Paul Harbrecht, as well as Daniel Stiles and Ned Baum at Syracuse. And I sort of differentiate between two waves of this criticism. The first wave emphasized the effects of financial institutions on matters of corporate control. And in the 60s, there's a broader concern about capitalism itself and big questions about the kind of social values of American industry as they're being warped by what are imagined to be the incentive structures that the system are establishing. Finally, by the mid-1960s, there was a lot of kind of concern about these developments. Market observers began to see institutions as reordering securities markets in their image and a threat to traditional institutions like the New York Stock Exchange in particular. Institutionalization had created novel and growing power within the field of financial intermediation. Donald Mackenzie, in a recent article in the London Review of Books, actually this was about 3 years ago now, described an arms race in financial intermediation. And I think we have a similar dynamic here where you start to see dynamics of economically, not very economically useful deployments of financial expertise that's developed just out of competition between intermediaries. And I think you see that dynamic beginning here. There were also concerns about how consolidation through these small numbers of financial institutions would lead to corrupting incentives like the use of insider information, churning, things that we are aware of now in mutual fund management. I'll just conclude by noting what I see as important about this story. In my own research, I see this emphasis on this period and this process of institutionalization as important for situating the story that Donald Mackenzie has told about the emergence of financial economics, including developments like modern portfolio theory, capital asset pricing, the efficient markets hypothesis, et cetera. I think it's important to situate it within this moment as researchers are trying to come up with methods to proceduralize the rules of investment. These are about forms of codified bureaucratic decision-making. Many of the sort of quant researchers of this period cut their teeth developing methods to adjudicate through numbers-backed methods the performance of fund managers, and this comes in a context where the ability for in which highly intermediated market individuals are increasingly relying on abstract performance metrics to judge the success of portfolio managers. And as a final kind of note about this, the randomness of price movement, as is studied in this period, emerges in a context where the ability for these investing institutions to move prices is a specific and quite vocalized social concern. And as I've mentioned, the origins of computer technology are situated in this period in which institutions are calling on new mechanisms to trade. And finally, just to note more broadly, I think this period we see a dynamic emerging that is quite common in American financial capitalism today, in which more and more Americans are invested in the booms and busts of the stock markets, but through these highly intermediated ways. Our entanglements with the stock market are opaque, mediated by institutions, and what it means to be in the market, who has power over firms, who is a capitalist, what is our degree of culpability over the actions of firms that we have notional ownership control over. Those kinds of concerns are emerging during this period. So I'll stop there. Thank you so much, and I look forward to your questions.
Thank you so much, Devin. Now we have about 25 minutes for questions. We can have questions on chat, or you can use the raise your hands function for questions. So I think I will start with a question of my own. I was telling Devin a little bit earlier that I was fascinated by the story about professionalization. And I have a question about the emergence of this category of financial analysts, right? So I was a bit puzzled about whether what you're trying to tell us is that there is a process of emergence of a new kind of financial analyst, or if there is a process of differentiation, right, from early predecessors. I'm writing a piece on early 20th century financial analysts, and there is like a booming literature on financial advice that tries to cater to this kind of expansion of the small investing public in the US and in the UK. So I was just wondering, how do you see, is this a new class? Are they trying to acquire new characteristics? So what can you tell us about this?
Yes, thank you very much. Yes, sorry. So I do not mean to imply that like the profession is emerging for the for the first time during this period. Instead, what I mean to describe is a series of efforts by trade groups, the stock exchanges, as well as federal regulators to impose a series of more stringent guidelines and professional standards upon a range of financial advisors and analysts. So for instance, throughout the 1950s, there's a series of securities and exchange studies of sales techniques and securities analysts. And those are largely concerned with the lack of financial experience and kind of technical knowledge that these figures seem to have, that they are good salespeople, for instance, but not technical experts who have no knowledge, who may not have, for instance, knowledge of the sector in which they're giving advice on. So there's an effort to produce a more rigorous professional identity associated with a new vision of professional identity connected with these more quantitative methods. And they are emphasizing a kind of a quantitative vision of financial analysis, because these new systems like modern portfolio theory are predicated on this idea that you can somehow sort of amalgamate quantitative judgments and turn them into you can proceduralize that kind of decision making. So I would associate it with a kind of, the emergence of the MBA on Wall Street during this time as well.
Great, thank you. So we have a question from David Pinzer. Thank you.
Hi, Devin. Thanks for this talk. It was very interesting. I wanted to ask if you could say a little bit more about this question of why institutional investors were investing in stocks as opposed to other assets. So, I mean, you point out these few different reasons, which I thought were all quite interesting about, changes in the law regarding where insurance companies could invest, the performativity of making something a good investment, and the exchanges actively courting. And I'm just curious if you could get a bit more into at a finer time scale. I mean, was there a key sort of pivotal moment where one change leads to others? Are these happening in some sort, are they building upon one another in some sort of more complex way? I was just really curious about how this becomes the chosen asset class, the chosen place for these institutional investors.
Yeah, thank you. It's a very helpful question, and I'm glad to clarify it. So I think my kind of rough chronology is sort of that there are a few influential, so for instance, folks that are involved in like the institutional investing societies, like the professional organizations, they tend to look at a few individuals, individuals who between 1949 and 1951 are influential in moving a few significant private pension funds into stock investment. And that's the Carnegie Steel Pension Fund, which goes into stocks in 51. The other is and I've seen discussions of this in particular. In 1949, the Federal Reserve System's own pension fund starts investing in stocks in 49. And Sears Roebuck, also between 49 and 51, they begin to diversify their portfolio from being almost entirely Sears and Roebuck stock to being diverse, or a slightly wider allocation of stocks. Some of the figures who are involved in those investment decisions are involved in other kinds of fiduciary organizations at the same time. So, for instance, there's this person whose name comes up in oral histories of institutional investing in this period, who was at the Carnegie Steel Pension, and then he was also responsible for Princeton University's endowment going into stocks, also in the 1950s. As for the public pension funds, they are a bit slower because they tend to be, often their fiduciary guidelines are more like explicit, they're more like legally entrenched. So the earliest ones like New York City, New York State are in the late 1950s. Wisconsin, my own pension fund at the University of Wisconsin system is in the late 1950s. But that really takes until the 60s for public pension funds to start going in. So, and then, that's why it's a bit of a dodge for me to make this performativity argument, because, it's not clear to me exactly who's the prime mover. But certainly once it starts, at least the participants seem to acknowledge that it was a performative, that the fiduciary, what counted as prudent was quickly spread.
Melissa Vergara Fernandez has a question.
Yeah. Hi, can you hear me?
Yes.
Okay, brilliant. Yeah, thank you very much for that very interesting talk. I just have a question, and I'm not really sure how to frame it, but so the story of Mackenzie has been, or at least the one I know of his performativity thing of kind of developments of history of theory to shaping financial markets. And this is on this basis that he has made this point about financial economics being performative. And I wonder whether you could say something about how this story of yours fits in that story, because even if you haven't really made a causal claim here about the institutionalization of stock markets into theory, you somehow also suggested, if I understood correctly, that this was the background, say, in which we should understand also the development of financial economics. So could you maybe say something about that, please?
Yes, thank you. It's such a wonderful question, and it's very helpful for me to think about. So I think what I'm trying to add to Mackenzie's performativity argument about financial economics in this period is to sort of situate these developments in a framework that's maybe closely associated with someone like the work of Ted Porter. The idea that practices of numeration, quantification, and procedural reasoning are situated in a public environment in which expertise defines itself in anticipation of a kind of public auditing of its process. And so I think while the performativity thesis is true for the way that expert knowledge gets taken up and performed into reality in the specific case of the Black-Scholes equation, these earlier developments, to me, I think have to be situated within, you can't treat the market as separate from this broader political economic condition in which these experts are trying to use the rhetoric of professionalization, the kind of the rhetoric of quantification, computerization to make their work seem procedurally rational and to form this professional identity. So I think when you look at, like, for instance, the figures who are involved in modern portfolio theory, capital asset pricing, they are all working, and FAMA and even Merton, they're all working in tandem. Much of their work is engaged with these problems of public auditability, to put it one way, public auditability of financial judgment. And so efforts to create, these, seemingly objective metrics like mutual fund performance or stock market randomness as a datum against which to evaluate individual investor success or ability. That's situated in this moment. And so I'm making an argument that the profession is constituting itself kind of in light of the threat of public auditability, because these are fundamentally public institutions in a way. They are institutions that they're always operating on behalf of third parties. So their judgments have to be procedurally auditable. They can't be, they can no longer rely on intuition or judgment. And that's something you see in the literature too, kind of self-reflexive sense that no longer could we operate on intuition. We had to operate in this bureaucratic way.
Amy Edwards.
Hi, yeah, can you hear me?
Mm-hmm.
Brilliant. Thank you so much for a really interesting paper. I really enjoyed it. I guess slightly building on the last question, I was interested in how far these institutional investors are kind of trying to actively construct how they're being understood. You mentioned some of the kind of public and political debate around whether this was a positive development or a negative one. And I suppose I'm slightly more familiar with the British context where this kind of process was partly normalized by institutional investors playing it really actively, trying to, both in lobbying government and in the way that they marketed their products, of trying to claim that they were democratizing access to the market. And I just wondered if you could say more about if a similar thing was going on in the US context, or how far they are trying to shape how people are perceiving their apparent growth and strength.
Absolutely. Certainly, there's a framework of shareholder, sorry, not to confuse the terms, but because Julia Ott refers to shareholder democracy, but there's a vision of shareholder capitalism that is being advocated by the pension funds themselves. Like there's these big ads that General Electric, for instance, puts out that are advocating for sort of like notional labor ownership of the means of production through these kinds of pension fund activities. You see in the mutual fund space, which is happening in parallel and is connected but not exactly the same as some of these other institutions, the language of democratizing the techniques of money management explicitly. Especially in the late 1960s. And notably, many of the figures in the US who are associated with like index funds and passive investment are coming from institutional investments. So they're people who are coming from TIAA, CREF, or bank trust companies, and then saying, let's take these techniques that we've developed to proceduralize various kinds of investment decision making. Now let's just make them possible for everyone because they're so cheap now that they're automated. The other factor is that the New York Stock Exchange is seen as sort of the specific Goliath against which these the institutional investors in the 1960s can say, well, we're representing these vast publics, and so brokerage rates are good for Wall Street, but bad for people. So we should erode them, things like that. So I do think that there's a kind of cultural campaign, specifically in the private and public pension funds. The insurance companies I don't think they like to talk very much about what they're doing with like their reserve money. But the other parties definitely are framing it as a kind of new stage of capitalism that's broadly socially beneficial.
Brilliant, thanks.
Do we have any more questions?
I can intervene while people perhaps ask more questions. I just want to read there's one comment by Bernardo Matislazo. He's saying there's a paper in the Accounting History Review on the emergence of financial analysts, of the financial analyst, and that it's practitioner oriented. So perhaps something to keep in mind as well.
Thank you.
Also, well, I want to thank you for your great presentation. It's a very interesting paper. And I think my question is building a bit on previous questions by Amy and Melissa, but perhaps it's from the government's perspective. I don't know if you run into any sort of documents or information that told you a bit about the role of the government in terms of the extent in which they promoted this process of the institutionalization of financial markets in order to promote the democratization of access to these markets by middle-income households. You mentioned a bit about this, having in mind this process of the affluent society in the post-World War II period, and this related to the American dream, so household thinking of organizing in a better way or in a more formal way their finance and this opportunity of access to markets. I don't know if you have any information on the government's role within this process.
Thank you. It's an interesting question. So, you know, Michael McCarthy has written a really wonderful book about pension fund investment by labor unions. He makes an argument that political actors use institutionalization as a way to sort of mitigate anxieties about capitalism in the 20th century. So there are ways, just like as a kind of technique of placation of labor unions. So giving access to security, but also establishing laws like but also the law, but also establishing laws that basically prevent labor from having a say in corporate control. So a pension fund can receive, you know, money from, share profits in companies, but not have a say in corporate governance. My view is that through the 1950s, the federal government is not very active on promoting institutional investment for the benefits of households, but instead from the vantage of a perception of a capital shortage, that there's a capital shortage for American enterprise after World War II that has to be made up for. And so like so for instance, the deregulation of insurance company portfolio ownership is an explicit effort to bring capital into firms. In the early 1950s, like the expansion, post-World War II, early expansion in American industry is largely financed by debt, and there's concern that it should be equity financed. So there's an effort by the US government to incentivize capital investment by these institutions. It's not really focused so much on small scale, on households. In the 60s, I would say there's a much more activist Securities and Exchange Commission who embarks after there's a series of scandals in the early 60s related to mismanagement of institutional funds. And it's in the wake of them that there's a series of studies by the Securities and Exchange Commission, one famous one called the Wharton Study that's funded by Congress. And these are efforts to to see to what degree individual households are being sort of duped by this system, like whether or not there's a lot of mismanagement and waste, and what effect the industries, the intermediation industry is having on share prices. So I would say it's slow going and not quite very active. I don't think that it's not quite like in the early 20th century where there's a strong effort like that Julia Ott describes to get people invested in stocks as a matter of kind of associated with political values. I don't quite see that happening. But clearly then in the 1970s, you have, a quite radical transformation with the ERISA laws and the development of individualized retirement accounts and that sort of thing. So the role of the state, I think, kind of grows. I think they, like the exchanges, are not, there's a great quote by the president of the New York Stock Exchange in '54 where he says, we were surprised by the scale of institutional capital. And it took a while, I think, for the federal government as well as the traditional financial industry to recognize the scale of what this kind of investment was going to be like and what it was going to do to the market.
Perfect. Thank you so much, Devin, for this great paper and talk. I would like to thank you all for coming as well. I would also like to remind you of our next session will take place on January the 18th. We will have Gert-Jan Fertig with the paper Go Active or Stay Passive, Financial Innovation and Under Diversification. Thank you and have you all a wonderful week.
Thank you all so much.